We're witnessing right now. It's an extraordinary, historic moment in China. These protests are breaking out across the country, from here in the capital in Beijing to elite college campuses to other major metropolises and even far-flung cities. This is an unprecedented level of public dissent since Xi Jinping took power a decade ago.
There has been unprecedented social unrest around China this week, and we haven't seen something like this since the Tiananmen Square incidents that happened in the late 80s. So it's been a very long time since something like this has happened, and what I wanted to talk about today is what effect this might have in U.S. markets. The first thing we need to do is we need to understand that markets are forward-looking. They're not looking at what's going on right now. They're predictive, right? And they look into the future and they try to figure out what is going on in the future, and they discount that back into today, and that's how the market trades, right? So basically what's going on right now is I'm gonna show you why I think that there could be something on the horizon that could affect the stock market. Not set in stone or anything like that, but you're gonna see by the end of this video why. So here we have Bank of America macro and market forecast for 2023. A few important things I wanna talk about. So first off, we have potential mild recession, we have lower inflation, we have higher unemployment, and then we have a stronger China. In this mild recession, we have GDP growth actually being negative in 2023, and this is going to be basically a very shallow recession. Nothing crazy, but definitely a little bit of a lower GDP growth, negative GDP growth. We have inflation coming down, that's good, but we have unemployment going up, not necessarily good, of course. And then this is the interesting part, which we want to focus on today, because we're talking about China. Stronger China. COVID reopening sees GDP growth in China from 5.5% up from 3%. And we're going to kind of, we're going to combine and understand like the flow of why this is kind of important. But first off, let's talk about Goldman Sachs and how they have a bit of a different idea about this. So here they have China's COVID restrictions and property are going to slump. So China's been going through a property crisis, basically. And so we have this other part that says we expect global growth of just 1.8% in 2023. We have our European recession and a bumpy reopening in China. And then it says U.S. should narrowly avoid recession. So this is a bit different, right? So Goldman Sachs is thinking that there is going to be, we're not going to have a recession in the U.S. Unlike Bank of America, they think we're going to have negative GDP growth in 2023. Also a bit different of a strategy report here from Goldman Sachs is they don't think that there's going to be high unemployment. So only 0.5 of a percentage point increase in the unemployment rate. And we saw before, if we go back, we had an unemployment rate going up for Bank of America's forecast of going up from 3.7% up to 5.5%. So that's almost 2 percentage points. So definitely a big difference, only a 0.5 percentage point here for Goldman Sachs's, what they think is going to happen with unemployment. Then we have China down here. It says China is likely to grow slowly the first half of the year. And as an April reopening initially triggers an increase in COVID cases, the thing with the reopening is Goldman Sachs has opening a little bit earlier than some of these other places do. They have a reopening in April time period, right? And so some other strategy reports, they have it May or even summertime. So this is a little bit earlier. And so we have to kind of assume what's going on with all of these different ideas and how if some of these don't end up occurring, how that could be bad for maybe the potential U.S. market because of what's going on with what we think is going to actually happen in terms of the important parts right now, which are inflation, which are interest rates, and we're going to talk about all that. So first off, we have mainland China's COVID cases, and maybe you're watching this in the U.S. and you're like, well, you know, we have COVID all over the place in the U.S., so whatever, right? So very different in China. China's been on a zero COVID policy. If there's a single case in an area, they're going to lock down the entire area, and it's weighing on the people that live there. And here we have basically spikes in COVID. And here's a Jim Bianco tweet. It says, I agree right now that it might be the chart for global growth in shipping. And yes, zero COVID will probably get relaxed in spring or summer of 2023 in China. But first, we will see several months of crushing lockdowns and production problems that impact everyone. And so here he goes on into an interesting chart here. Actually, sorry, this is the Goldman Sachs chart from the strategy report that I was just sharing. And this is China will need to ramp up vaccinations before reopening can safely begin. And so one of the parts and issues about what's going on in China and why it's not going to just suddenly reopen is, first off, here we have the percent of the population that is unvaccinated elderly. And so it's a very high percentage on the left side here of unvaccinated elderly that's in China. And so they feel like that's not going to be good if they reopen. This actually happened in Hong Kong. They had their own problems with the elderly population in Hong Kong when they reopened. And then down here, it says China's ICU beds, they don't have enough ICU beds for them to essentially reopen without really crippling what's going on inside their medical facilities in China, and not necessarily just in metropolitan areas. A lot of these is like outside, let's say, metropolitan areas and like provincial areas and stuff like that. So next we have daily COVID vaccinations administered in China, 7-day moving average, and of course it's way down than from what was in the peak. This is basically just telling us that China's got their issues right now. They have this zero COVID policy. They're basically relying on this to be like, okay, we're going to shut COVID down whenever it enters any type of area. And they're getting very, very strict with it. And the population is actually starting to uprise against these policies. We're looking at a tweet from Unusual Whales showing a reported video of workers that are fighting with guards at Foxconn's technology plant, which makes iPhones. And so this is mainly based on the conditions that they're working in and the lockdowns that they're putting up with based on zero COVID policy. This leads me into an interesting tweet from Jim Bianco and why this is important. And he says basically, I believe mistaking this chart as the supply chain is fixed, inflation is contained, rather it is lock damage and or slowing global demand chart. This decline is not yet signaling the supply chain is fixed. And what he's showing you here, this says European container rates exceed China container rates. But basically, over on the left, we have freight index from China to the East Coast US in blue, West Coast in orange or yellow. And basically, it's showing obviously that freight costs are way down. It is because of bottlenecks in supply chain. And the supply chain is fixed because obviously we're coming back down to very normalized levels. So the question is, what Jim's kind of alluding at here, what if we're not yet fixed? What if the supply chain is not fixed? What if we have COVID issues in China? What then happens to the supply chain? And then what happens, and if that does happen, what happens to inflation in the US? Because if there's supply chain issues in China, that will probably, likely, I would think, lead to some type of inflationary pressure inside US goods and services. This all kind of brings us into the idea and the question of, does this end up happening? Is this a scenario that happens? So do extended lockdowns lead to supply chain issues, which lead to inflation, which lead to higher prolonged interest rates, which then lead to lower stock prices and higher bond yields? And sorry, by the way, if there's a dog outside barking, street dog, can't do a thing about it. But that's the issue, right? Is it possible that lower stock prices are a result of all of this in the US? And I don't know if that's going to happen. I don't necessarily think, to me, I don't think that this is going to be a huge issue of what's going on in our general economy in the United States. I don't think China is going to make or break stock prices in 2023. But, I like to kind of be positive at the end of these videos when it's kind of about maybe a potential of a downturn in stock markets or the economy or something like that. So if we take a look at my portfolio, this is how money flows in my portfolio. I've shown it to you before. And so I have individual stocks, 35% of my portfolio goes in there. Momentum, this is all based on stocks. I use a rule-based strategy to find cheap momentum stocks, and it's individual stocks. This is 25% of my portfolio that I add into the market. Then I have tactical market. I try to recreate the S&P 500, basically, like all the sectors, and I overweight the sectors I like, and I underweight the sectors I dislike as much. And then miscellaneous strategies. So if I see something interesting that I like, for example, energy was a big theme this year for me. And I have 10% there, 5% cash. And this is what I'm trying to do. I'm trying to basically allocate money into these different areas. I'm not always doing a great job doing it. Sometimes I have more money in cash because I can't find stocks. I don't have much time to maybe analyze things as much as I would like to. So, of course, at the end of the day, I'm investing is what I'm trying to tell you, that I am putting money into the market and I'm doing my best to continue to invest, even if, for example, China does show signs of a lengthier lockdown. I'm still going to keep investing, and I feel like it's important more now than ever to make sure that we talk about the fact that there are brokers that sometimes go out of business because they're cryptocurrency type of brokers or whatnot. And I'm talking about FTX here. And so just remember, these are the different accounts that I'm using. These are the brokers I'm using: Charles Schwab, Robinhood, M1 Finance. I am using the registered broker dealers that have FINRA oversight, that have SIPC insurance protection, and I don't have any type of place where I'm adding money that has some type of weird like offshore type thing like FTX. I don't have anything in any type of place that doesn't have stocks that are SIPC insured. Basically, what I'm saying is, if you're investing, make sure you have the right broker and don't try to go with something that maybe doesn't have great regulations. That's all I'm saying. So anyway, I hope you liked the video. Let me know, do you think this is an issue? What's going on in China right now? Hit the like button, subscribe. Disclaimer here. See you next time.